Okay, hi everyone. Welcome to Master Key Associate. Today we are going to continue with our topic on impairment of assets, IAS 36. Last week we commenced the topic. We look at the meaning of impairment and we defined some basic concepts that will help us to understand the principles of impairment. Impairment, we said, of course, when the carrying value of an asset is greater than the recoverable value or amount. Now, according to IAS 36, the recoverable value of an asset is the higher of the fair value less cost of sales and value in use. Please mute yourself. Fair value less cost of sales and value in use. So we said that the fair value less cost of sales is the amount that will be realized from the immediate sales of the asset less the cost incurred to sell the asset. So while the value in use is the present value of the estimated future cash flow. I will remove you of the future cash flow to be derived or realized from the continuing use of that asset in the business. So it means that in a standard question, you might have information on the fair value less cost of sales and the value in use. So the higher of the two is your recoverable value. So you compare the recoverable value with the carrying value, you can determine your impairment. Also, you look at the accounting treatment. Please mute yourself. It's very simple now. It's very simple. Please. Balogun, please mute yourself. So we said that when you determine the impairment, another important thing is how do you account for the impairment in the financial statement or in the books of account of the company. We said to account for impairment, you have to look at two things. Number one, what is the model or the method used to record or to carry the asset? Remember, according to IAS, property, plant, and equipment, an item of PPE can be carried either at cost model or revaluation model. So the method used, okay, to recognize the asset would determine the treatment of impairment. So we discuss all that. I also said in that class that under IAS 36, okay, impairment can be viewed from two perspectives. From a single asset, okay, a single asset. Two, from a group of assets. Please be with me now. We are going into this now. From a single asset and what? From the group of assets. So I will look at the impairment of a single asset in the first class. Now, today we are going to start with the impairment for a group of assets, okay? What we call the CGU, cash generating unit, the CGU. Now, anytime it becomes difficult, to determine the cash generated by a single asset, is that clear? Because we cannot determine the cash that is generated by a single asset. In that case now, we are going to subject, okay, the whole of the asset in that group to impairment test. Is that clear? We are going to subject the whole of the asset in that group to impairment test. So now, cash generating unit, okay, could be a department of an organization. It could be a branch. It could also be a subsidiary. Okay, this is the smallest group of assets for which independent cash flow can be identified and measured. Okay, so your CGU could be a department in an organization, and in that department, there are assets, okay, in that department. It could be a branch, okay, it could be a subsidiary. So anytime it becomes impracticable, it becomes difficult for us to measure precisely the cash generated or attributable to a particular asset, then we cannot test impairment on that asset. Instead, we now subject all the assets in that group to impairment. Is that clear? So now, how do we now measure? Okay, how do we measure the impairment? The impairment of a CGU, cash generating unit. Class, impairment is impairment. Now, the CGU is said to be impaired, or let me say, now, CGU, okay, is said to be impaired if the carrying value, okay, of the CGU is greater than the recoverable value. When the carrying value of the word CGU is greater than the what? Recoverable what? Value. Yes. So you measure the impairment of CGU in the same way as that of a single asset. Please, class, be with me here. It's been long I can tested you on this aspect at both levels. Please. So the same process. And you know that the recoverable value, okay, is the higher of the fair value, less cost of sales, and value in use. So that is that. Now, when you have now determined the impairment of the CGU, the next question you should ask yourself is, how do we treat the impairment? Okay, right? The procedure for treating CGU impairment. Class, there are procedures, okay, that you are going to follow when you are treating the impairment of a CGU. Why? Because under CGU, we are talking about 2 or 3 assets. Is that clear? So it is not the same with the impairment of a single asset, where you just debit and you just credit. So in the case of CGU, when you determine the impairment, right, you are going to follow a certain procedure. And I want you to memorize this often. I can often test this. So now, according to IAS 36, okay, what are the procedures, okay, for treating the impairment of CGU out there? Now, the first step now, okay, right? The first step, you allocate, okay, okay. Firstly, let me say, firstly, okay, firstly, you allocate the impairment to any damaged or destroyed asset. That is the first thing. You first allocate to any damaged or destroyed asset. Second step now, secondly, okay, now, when you have allocated the impairment to a damaged or destroyed asset, and you still have impairment left, okay, then you now what allocate to the goodwill of the CGU. Is that clear? So you now allocate to the goodwill of the CGU. So the goodwill should be completely written off, okay, to zero level. Be with me here, please, till zero level. Now, after allocating to goodwill, if there is still any impairment, so you now come to the third step. Thirdly, okay, you now prorate. Hello, you what? You now prorate the remaining impairment on the other assets in the CGU, apart from the damaged asset and the goodwill. Is that clear? These are the three procedures. However, if there is no any damaged asset, then your first step would be to allocate to the goodwill. Okay, so after the goodwill, if you still have any, you now prorate on the remaining asset. Is that clear? Now, when you are prorating, remember, please, a condition. Now, do not allocate impairment to monetary assets. Please, I'm coming. Do not allocate, okay, impairment to monetary asset. Is that clear? Now, class, in the CGU, the examiner will give you monetary asset like what? Inventory, okay, trade receivables, okay, and others. Do not touch them. Why? The impairment of this asset are out of the scope of IAS 36. Remember, that is, their impairment is captured and treated in line with the standard that governs each of them. For instance, impairment of inventory, okay, is in line with the IAS 2. Also, impairment of trade receivable is in line with IFRS 9 financial instrument. So when you have monetary assets, okay, in the CGU, hello, it is time bomb. Do not allocate to them, except the examiner takes you expressly to do so. Is that clear? So this is what you are going to do. Please go on. Najima.
Sorry, sir. I was dislocated. My network, I could not get the third allocation, sir.
Okay. After you have allocated to the second to the goodwill, okay, to the goodwill, and you still have impairment left. You still have left. Then you now prorate now the remaining impairment on the other asset in the CGU, except from the damaged asset, the goodwill, and monetary asset. Is that clear? So, class, that is that. So, straight away, class, let's look at question number number 8. Jaguar, please. Jaguar. Question 8, Jaguar. Please bring your hands down. Thank you. Question 8, Jaguar. Let me first show you, okay? When the CGU, when there is no impaired or damaged asset. Yeah. Now, please be with me here. It is a pity that my students don't maximize the value because they don't listen. Yeah. Please. Now, let us go through that question together. Okay. In this case, there is no damaged asset. So after this, we are going to take another bigger question. Then we move to IAS 12. I am still going to touch some of the questions in this material impairment once in a while, okay, with other things I am doing. Okay. Now, an impairment test on 31st December 2000, Jaguar Limited concluded that one of its CGU has been impaired. Okay, no alert, impaired. The recovery amount of the CGU was 970 million. Why the carrying amount is what? Of the CGU as at 31st December 2000 is shown below. Okay, is shown below. Now, here you have the CGU, the goodwill, the patent, freehold property, P&M, motor vehicle, net monetary asset. Plus, now, the first thing you should do is what is to determine the impairment. I mean, determination of impairment. What is it? It's on 31st. Class, what is impairment? Is the carrying value of the what? Of the CGU. Abi, what do you have there as a carrying value of the CGU? Is how much? Yes?
970.
Thank you. Thank you. 970. Okay. Now, what is now the
It's wrong.
No, it's wrong. Wait. Sorry. The carrying value is 1 million.
1,550,000.
1 million. I was like, what happened?
So but excuse me, sir, I don't have this material.
What we used last 2 weeks. I cannot teach a class without material. Yes.
Sir, can they help us and report it?
Okay, please let them do that.
Hello, sir. I also don't have this
that
material too.
See,
Hello, sir. Are you
okay,
please
please,
repost this
class, help
material,
us
please?
just that, okay? You are going to prevent me from doing IAS today. Okay. I'm sure. Okay. Thank you, Jerry. Thank you, Sana. The material was what we used last 2 weeks. Now, the recoverable, okay, amount now, less recoverable amount of value is 970. Now, impairment occurs if the carrying value is more than the recoverable value. So in this case, we have impairment of system. Impairment of system. Yes. So the CGU has been impaired by how much? 610,000. Now, the second step now is how are you going to allocate? Yes, because this impairment is for the whole of the CGU. So you need to allocate it among the assets in the CGU. That will be step 2. Question B. Allocation of impairment. Okay, here you have the asset, the carrying value, okay, they have the impairment itself allocated. Now, the carrying value now after what? Impairment. The carrying value after impairment. Yeah. So let's go one after the other. What you are going to do first, class, is you are what? You are going to restate, okay? Let me say you are going to state first the assets based on the original value. Here we have goodwill. We have patent. Here we have freehold property. Here we have plant and equipment. You have motor vehicle. Then you have net monetary asset. Okay. So now the initial value is 260. Please help me check. For the goodwill is 260,000. For the patent is 122,000. Freehold is 549. P and E is 305. Motor vehicle is 244. Here you have 100. If you add, you have here 1 million. Okay, this is the initial carrying value. Okay, class. You know, I said that the intent of the CGU follows a procedure. Okay. Now, the first step is what? You allocate to any damaged asset. Here we have 610,000 as the impairment. But in this question, there is no case of any destroyed or damaged asset. So you now what? Go to step 2. You now allocate to the goodwill, okay? To the goodwill. Here we are having 610. So you write off the whole of the goodwill. Okay? So here we have now 610,000 less 260. We still have impairment left. Okay? We still have impairment left. Now I told you that you do not allocate to monetary asset. You have one here, just come here. Just transfer what you have here to it. Yes. So 610,000 minus 260. What do we have there left as impairment? Yes.
350.
350. Thank you. Now, the third step now, you are going to prorate. Yes, on the remaining asset, the patent, freehold property, P&E, and motor vehicle. Exactly. So let's do that now. We prorate, we know how much we charge to each for the impairment. Proration of remaining impairment. Okay. Today, let's say, here you have 610, are we? We are giving goodwill 260. So we are having 350 left. So we are having 350 left. So that is what we are having left now, okay? Okay, as what? As an impairment. So let us do it now. Here we have patent. Here we have 3040. Here we have plant. Here we have motor vehicle. So you first write now their value. Here we have 122,000. The patent 549. Here we have 305. Here we have 244. So the total value, okay, of this now is 1,220. Over there. Now we are having 350,000 left as impairment. And we need to share it because it's a CGU. So the impairment cannot be borne by just one asset. So now, for this now, patent, you will say, please just watch me, please. The value of the patent over the total asset here, 1 times the remaining impairment. This you have here, the value of this 549 over 1 times you have here, the value of this over 1 the last now. Over so that is how you are going to do the what allocation. Now, to patent is 35,000. We are keeping 30 up. That here is what 1. Okay. Sorry. Okay. You're having 1. You're having 8, 7. You're having 70. Okay. So if you add that back, please, are we getting the 350 back? Please, class, let me confirm. This will give us 350 back. Okay. So now you have now what allocated the impairment now. Okay. So let's now give okay to each of them. For the patent, it is what 35. Come here. 35. For the freehold property, it is 157,500. For the plant and equipment, it is 87. For motor vehicle, it is 70. Okay. So let's now find the carrying value now. Here you are going to have the total amount of the impairment. The 610. Okay. So this minus this, you have here new. This minus this, okay? There you have 87,000. This minus this, you have 391. This minus this, there you have 217. This now minus this, that's 174,000. If you add this back, okay, this must give you what? The recoverable value, the 970. So that is the allocation, okay, of the impairment of CGU. Now, question 6 now says, show the accounting what Abe entries. Of course, for every impairment, we need to show the effect in the financial statement. Yeah. So, and that is done through the accounting entries. Let's come here right away. The C part of the questions. I'm coming on. Accounting entry. Please go on, sir. Go on, sir. Go on.
Hello, sir. Sorry, I'm the 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 goodwill. I'm seeing in the impairment you are repeating 260 again. So I don't know whether
I said you are going to write off the you are going to write off the whole of the goodwill. Okay? Yes, you are going to write off the whole of the goodwill. So the goodwill will suffer the impairment cost. And since the value of the goodwill is 260, so to write off now, you will jacket the value 260. Here you have nil. So it means after the end of this year now, we don't have goodwill anymore. These are the carrying value of the asset. Had it been the impairment is not up to the goodwill, you will just write it to the tune of the impairment. Is that clear? Now you debit here. Debit here. Let's say profit or loss. Admin or
is that the network is very bad.
Mine is clear. Maybe it's yours, okay? Try and check your own, okay? I have a dashboard that regulates, that monitors the whole thing. Here is showing 100%. Try and check yours out there. The cost of what? Sales. Now, the impairment, okay? You know, I said that when you do your impairment, the treatment depends on the method used to carry the asset. Is it cost model or revaluation model? So under cost model, the impairment goes to the P or head at the straight. So what we have here is cost model. Mr. Noah, please, I'm coming. So the total year, we have 610,000, okay, as impairment. 610,000. 610,000 as what? As impairment. Remember, we are keeping 3 zeros, Abby, up. Now, okay, Mr. Noah, go on.
Okay, sir. Good afternoon, sir.
Yes, sir.
Sir, please, I wanted to find out that if there is a damaged asset to the tune that is more than the impairment, what will happen?
Okay, of course. Now, Nemo that could not abet in law, business law. Okay, you can't give what you don't have. So you are going to first of all allocate to that damaged asset to the tune of the available impairment and close. So it means the goodwill will not be affected, let alone the other asset. Are you clear?
Yes, sir. Thank you, sir.
Okay. So now we have you now what? Okay, credit the goodwill account. You will also credit the patent. You will also credit the freehold property. You will also credit the plant and equipment. You will also credit the motor vehicle.
Yes, sir. I don't know if it's from my end or from yours. The network is very bad.
It's your end, you okay, madam. Okay, try and log in. Sorry,
So
log out. Okay, and log in
are you
again.
using Airtel? Because I tried with my Airtel, it was bad. I had to change to MTN.
You see, if I'm having a bad network, I will stop the class. Yes, I have here a monitor here on my dashboard that regulates everything. It's a huge investment. Yes, huge one. So you can see. So please, madam, okay, try and check yours, okay? So now, all these, okay, assets, right, are affected. Remember, you debit the P or F for the payment, and you reduce the asset by the amount of their impairment. So now, for goodwill now, it's 260. I mean, for patent now, it's 35. For freehold property, is 15. Then for P and E is 87. For motor vehicle, 70. That is the end of the question. So you are what? You are going to reduce all these assets by their what? So these are the carrying value now that will appear in the statement of financial position, okay, as the value of the asset. Exactly. We are in the wet season, and the rain can also affect the network. Yeah, that is possible. Mr. Danjuma. Hey.
Yes,
Okay,
can we
go
have
ahead.
the board up? The board.
Okay, the
Can
board
you take
up.
it up small? Yes, thank you, sir.
Question number 4. Yes, please. You see, this question, I don't want anybody to ask any question. Yes, this question is long overdue. Yes, it's an ACCA question that we expect. So it involves the damage. Yeah.
Sorry, sir. The board again, sir. Up, sir.
So, do we have the video? Okay. Do we have the video? Our class, would you write now and don't have the video?
Let's listen. Let's listen. We need the video.
So we need video.
We need the video. We need the video.
I'm not writing.
So, question number 4. Are we there? Question 4. Class, let me give us 2 minutes now. Let's see. On 1st of January 2000, Smart Company PLC acquired Stream Limited, a company that operates scenic railway along the coast of popular tourist area. The summarized statement of financial position at fair values of the scheme limited on 1st January 2000, reflecting the terms of the acquisition was, okay, there you have the goodwill, the operating license, property, the train stations and land, the rail track and coaches, 2 steam engines. So you pay what? 300,000. That is the total purchase consideration you made when you acquire this. Now, the operating license is for 10 years. So, now, it was renewed on the 1st of January 2000 by Transport Authority and is stated at the cost of renewal. So it means that the operating license, okay, is at the cost, is at the renewal cost, which is the carrying value. The carrying values of the property and rail track and coaches are based on their value in use. Are based on their value in use. So they are based on their value in use. The engines are valued at their net selling prices. Okay. You can see that from the story up there, there is no issue. No issue. Listen now. On 1st of February 2000, okay, the boiler of one of the steam engines, please pay attention here. On 1st of February 2000, the boiler of one of the steam engines exploded. So exploded, completely destroying the whole engine. Fortunately, okay, no one was injured, but the engine was beyond repair. It was damaged beyond repair. That tells you something. Due to its age, a replacement could not be obtained, of course, because of the reduced passenger capacity. The estimated value in use of the whole business after the accident was assessed as what? At 2 million. Imagine. The initial carrying value was 3 million, okay, of the whole thing. But after this ugly incident, the value in use, okay, for the whole thing is what? 2 million on the 1st of February 2000. This is when we had these incidents. Point 1. Under that point 1, remember, engine has damage, okay, and we have 2 engines. 2 engines. So if one has damage, meaning what? You are having one left. You are not thinking what could be the cause of the damaged engine. You have 2 things. One, damage. Shouldn't you know that you should divide the total value by 2 so that you can get the value of the damaged one? Okay. Now, passenger numbers after the accident was below expectation, even allowing for reduced capacity. Of course, after the incident, that thing cannot work at the normal capacity. Therefore, the passenger value number has reduced. A market research report conducted that tourists were not using the railway. Why? Because of the fear of a similar accident occurring to the remaining engine. It's normal. In the light of this, the value in use now of the business was reassessed again on 31st March 2000 at 1.8 million. So now you are going to do now impairment test now on 2 different days. One on the 1st of February, 2 on the what? 31st of March. Okay. On this date, Smart Company PLC received an offer of 900,000 in respect of an operating license. The realizable value of the other net asset has not changed. Okay. Calculate the carrying value of the asset of the stream limited in a Smart Company. Okay. At 1st of February and what? 31st of March. This is 2 impairment tests. Please just listen. Those of you asking questions, please just listen. Just listen, please. If you listen to me, you get clear. Don't even bother to raise your hand. Don't even bother to raise your hand. Just listen to me. Let me teach you. You get it. Okay. Question 4. Okay. Smart Company. Remember, 2 incidents occur here. Okay. Yes. So, and this has what has led to the reassessment of the asset. Okay. Okay. Let's say event on the 1st of January, sorry, on the 1st of February. So on the 1st of February 2000. Yeah. Let's first tackle that event. Okay. So based on that date, what is the carrying value of the asset? Exactly. An event happened on this date, okay, such that 1, damage engine, okay, damage steam engine, now class, you have 2 there, okay, you have 2 engines, okay, now, and 1 is damaged. How do you now determine the value of the damage? The total value there is 1 million, okay, for the 2. If 1 is damaged, it means what? The half damage cost what? 500,000. Okay, the half damage cost 500,000. Yes. Okay, now what is the impairment for the whole value? Okay, as at this date. The impairment now okay equals to the what? The carrying value which is the purchase consideration. Okay. Yes, the carrying value is the total value of all the assets, which is what? The purchase, the amount you paid initially to buy or to acquire this. And after this incident, class, the thing was revalued. Okay. And as what? A value in use of what? Of 2 million. That is a recoverable value. The value in use, the 2 million, you less. Here there is an impairment of 1 million. Okay. The question says, what is the carrying value of the business asset, okay, on these 2 different days? So let's now say now the carrying value now, okay, of the business asset on this date, on the 1st of February 2000. Okay, so now allocation of impairment. Okay, this is happening on the 1st of 2. Yeah. So the asset force, yeah, the carrying value, the impairment. Now, the carrying value now, okay, the carrying value now after impairment. Yes, you can see. We need to know the value of the asset after the first incidence. Yeah. So we have in thousand. So here you have the goodwill first. Next, the operating license. Okay. You have the, let's see, license. Next, we have the property. The property, okay. The train and what? The train station and land. Next, you have here the rail track. And coaches. Next, you have here the 2 steam engine. Okay. 1, 2, 3, 4, 5. 1, 2, 3, 4. Okay. Now here you have the 200,000, 1.2, 300, 300, 1. You add up. This is the initial carrying value. Class now. In this kind of allocation now, what are we going to do first? Tell me. Yes.
Allocate to the damaged assets.
Thank you. Now, what is the total the total value of the impairment is 1 million. Abi? Okay. And we have a damaged asset here. And the value of the damaged asset, okay, is 500,000. So it means we should first of all, okay, allocate to the damaged asset 500,000. Yeah, we have here 500,000. So we have left here, we have 500,000 left here, are we? Yes. Now, after the 1 million, sorry, after the 1 million, we have taken 500,000. How much do we have left as impairment? Is 500,000. Is that clear? So now, allocate what to goodwill too. Since the impairment covers the whole of the goodwill, you write off the whole of the goodwill. So, how much now do we have left now as impairment after the allocation? Tell me.
300.
Thank you. Better. Thank you. So, it is this now what you are going to prorate. Okay. Now, proration. Of you less 500, you less 300, you less 500, you also less 300, 200, you are having 300 left now. Okay. We are having that left, okay, as in unallocated impairment. So, let's do that now. Proration, we have operating license. We have property, the train. You have rail, Abi. You have the rail trucks. So here we have 1.2. Here we have 300. Here we have 300. Here we have 1.8. So allocate now 1.2 over 1.8 times the 300. Here we have 300 over 1.8 times 300. Here we have so here we have here 200, are we? Here we have 50. Here we have 50. So that is the proration. So for the license, okay, 200 value is impaired. Here 50. Here 50. This and this new. Here you have 1 million. Here you have 250. Here you have again 250. So the total value impaired here is 1. Here you have here 2 million. See now, that would be the value of the asset of that business, okay? On that date that incident occur. So, supposing you are asked now to show the accounting entries, which you should show, because it is that entries that you are going to use. Let's say accounting entries you have debit, the profit or loss, the full impairment, the admin or the cost of sales. So with the 1 million, the total impairment. Now credit, you also credit the 3 assets involved. You have, okay, the goodwill. Goodwill, okay, goodwill, 1, 2, 3, 4. Okay, 5. 5. 2, 3, 4. The goodwill, the operating license, the property train, you also credit the rail track, the steam engine, so the goodwill suffers 200, the license too suffers 200, the property train honest 50, the track 50, the engine, if you add, you must add. So that is what you are going to do, okay, as the accounting treatment. That is a treatment of the first event, okay? Now, second event now. So after this date, okay, when we have determined the carrying value, we thought that was all. So in the subsequent month, another ugly issue happened on the 31st of March, the same year. So what happened in that same year on March has reduced the carrying value. These are the carrying value of the asset after this incident. But because of what happened too, so the carrying value that we had here has been reduced. So we need to now find the new carrying value after taking into consideration the second ugly incident. So let's come here and treat that too in the same way. Come here. So I will call it event 2. This one, okay, event 2. This happened on the 31st, 03, 2000. Okay. Now, If you check there, let's see. It was reassessed, okay, that the value of the business on 31st March 2000 now was 1.8 million. 1.8 million. And when the event one happened, the value was 2 million. But now, what happened later now reduced the value from 2 million to 1.8 million. So it means there is an impairment again. So the impairment here will be the carrying value which is a 2 million. Yes, because the value at the end of that January will still be the opening value on the 1st of March. Yes. But by the virtue of what happened, it has dropped. So, and the recoverable amount less recoverable amount which is the value in use 1.8 200,000 another impairment. Something also happened to class. What can you say about the operating license? Yes, let someone please talk. What can you say about the operating license?
Please, sir, shift your camera to the middle, sir, please.
Okay, what can you say about that?
It reduced. The operating
By how
license
much?
can be reduced. So
By
by 300. By
no,
300.
no,
It
no,
was
no, no,
initially
no. Check it,
1.3.
check it, check it.
Initially it was
Let's
1.3.
see.
Now it's 900.
After now, this is now the new value now. Abi, so base it on this value. So
That's 100.
thank you, better. Thank you. Thank you. 100. Thank you. So that is also what an obviously damaged asset. Operating license that'll be from what has a carrying value, okay, of 1 million. And there's somebody is now saying the market true value is 900. So it means 100 is lost there. That is also what an obviously damaged asset because the value has reduced. You are saying that is 1 million, but in the market, it's only worth 900,000. Yes. So allocation now of impairment. On the 31st. Okay. You have the asset here. Please, I'm coming. I'm coming. The carrying value, the impairment, the carrying value now, okay? Afterwards, impairment again. Here you have here. So right now, in this case now, okay, we don't have goodwill anymore. We don't have goodwill anymore. Amarashi, please go on.
Okay, sir, please, that
Amarashi,
operating
go on.
license, that operating license, I don't understand it. That
Yes.
100 naira.
Now, see, okay, thank you. Now, please, okay. You see, after the first impairment, okay, these are the values of the business asset. Exactly. So you can say, oh, these are the value now of my asset. Yes, after we add that incidence. After a month after, okay, on March, something happened again, okay, to the business, which automatically reduce the value of the operating license. The question says that that license only worth 900,000 now. And if something worth 900,000 in the market as a value, and you are carrying it as what 1,000, okay, or 1 million, are we there? So it means what the true value that can be realized is that 900,000. So that is why it is reduced by that 100,000. Are you clear?
Yes,
okay,
sir, thank you.
So in this case now, there is no more goodwill because it has been taken off. So, but here we have the operating license. Next we have here the property train. Next you have the rail tracks. Next you have the steam engine. It's now one of it. It's now one steam engine. So the value here is 1,000. Here is 250. Here is 250. Here is 500. You can see you have the carrying value as 2 million. How there, class? 2 million. Okay. Now there is an impairment of 200,000 that occur on the 31st of March of this month, this year. But we have an obvious impairment on the operating license because by record, our license was 1M, but the true market price is now 900. So it means we can only get 900 here as a true market value. So what happened? 100 naira is gone. Over there is gone. Exactly, it's gone. So nothing happened again to the steam engine. So the steam engine is still at 500. Yes, because you allocate to that based on what happened to the engine. Exactly. Now, how much impairment now do I have left to operate?
100.
Thank you. Fantastic. That's good. 100. So, see, proration of impairment from the total of the 200, one has taken 100. I'm having 100 left. Now to property, next to real. So here you have 250. 250. Okay, am I correct? Yeah, that'll be 500. This will take 250 over 500 times 100. It is equal to 250 over 500 times 100. 50, 50. Exactly. So you come here, reduce by 50 by 50. So here you have 200 now as the new carrying value. Again, after this ugly incident, here too you have, I'm coming 200. Okay. Then you have the total of 100. Then you have total of 200. Okay. 1.8. 1.8. Okay, go on, Daniel, go on. Go on, Daniel.
All right. What I want to ask is this. Why you left the steam engine without touching? Because you said, how do you know that there is nothing happened to it?
Thank you, fantastic. Okay, you know the steam engine, okay, the impairment of that steam engine is special, okay. You will be told if there is any further damage out there. So in this case, there is no damage. Exactly. Okay. So you impair the steam engine when there is damage. So there is no any further damage out there. So it means one engine has blown off. Okay. So we still have the second engine in good condition. That is the assumption. Exactly. However, if the question has given us any further damage on it, so that would have been an obvious impairment because you are going to clear that first before we even prorate. Are you clear now? Daniel? Are you clear?
Yes, sir. Yes, sir.
Okay,
yes, sir.
okay. Those of you doing PSAF, also take note of this question. Yeah, please. Anyway, I will take you when we get to the PSAF impairment, but just take note. So the accounting entries now, okay? The accounting entries debit the profit or loss, okay? The admin or the cost of sales. And your credit, here we have 3 items. You have the operating license. You have the property. You have the rate track. This is 200. This is 100. This is 50. Class. So let's go now to IAS 12. Sharp, sharp. Income taxes. That is a major accounting standard. Yeah. That. Okay, go on. Say, I'm with you.
Okay, so please, sir, this accounting entries, is it the same mode of crediting and debiting? Does it apply to both cost and evaluation method?
Yes. Now, you see, okay, please put your mic. Thank you. Okay, thank you. Now, you see what we have here, okay? All the assets here, they are on cost, Abi. They are on cost model. So it does not affect revaluation one. Exactly. They are on cost model. Okay, so that is why you take the impairment to the P or L straight, okay, under cost model, and you now reduce the respective asset value. Okay, go on today. I'm with you.
Okay, sir. So I want to ask for the operating license was impaired by 100 naira. Then with the initial impairment, 200 naira. So I was thinking that you're going to use the two, that is 300 naira, but you only use 200 naira.
No. At the end of the first event, on the 1st of February, okay, that year, we have determined the new carrying value of the asset. These are their new carrying value now. Okay? It was after this again that another incident occurred. Is that clear? So you will be comparing with the new carrying value. Is that clear? Not the initial one. Are you clear? Okay.
Okay, sir.
Class, IAS 12 now, income taxes. Though I still have 1 or 2 years to help you solve, okay? But it's important. We have done the needful on this topic. Yeah. Any other thing is just extra. It's just extra. It's just extra. Welcome to IAS 12. Income taxes.
Sir, the material for this income taxes.
Yeah?
The material for this topic.
I have shared it now. Check. This class, help us repost. Please, okay?
It's there.
Except you are just joining, Abi. Income taxes. Class, please. Everything about this standard is what you must know. Because if you check your ICANN pass question, they will test you both on the theory and calculation. That is why I sent you both the theory notes, okay, both the notes and the calculate and the questions, okay, the notes and questions. Exactly. So it happens that the shareholders, okay, are concerned about the income tax that the companies put in the income statement out there. Because the income tax there constitutes a larger percentage of the profit. So as the stakeholders, okay, they are concerned that how can we have a proper accounting for the income tax, okay, for transparency and accuracy. So that brought about this IAS 12, exactly. And some people would believe that since the company income tax is 30%, they if you say 30% of the profit before tax should be the income tax figure you see, and it is not true. Yes, they will always say that, okay, 30% of the PBT should be equal to the income tax you see there. No, it's not true. Because your income tax, okay, in the income statement consists of 3 items. Yeah, it involves a lot of adjustment for us to derive that income tax we are going to put in the income statement. So that is the focus of this standard. Now, the objective of IAS 12 is to provide guidance on the accounting treatment of income taxes in the financial statement of an entity. So the scope now, the scope of this standard is very important. Scope of IAS 12. If we say scope of a standard, okay, it means what does standard covers, okay? IAS 12 will cover 2 things. One, the income taxes. Okay? All right. Let me say the current tax and the deferred tax. Yes, that makes sense. The current tax and deferred tax. So under IAS 12, we are going to be talking about the current tax, okay? The current tax and deferred tax. The current tax, okay, is the tax you are paying on your current income, okay, on your current. So the deferred tax is the future tax. We shall take it one after the other. Before we go into an example, let us take a look at some basic terms. Basic definition. These definitions are very, very important. I can ask you, please. I can ask you. 1 is the accounting what profit. The accounting profit plus your accounting profit is your profit before tax. Okay, before tax. This is the profit that is calculated or derived in line with IFRS, IAS, and other accounting regulations. Is that clear? And you know, for you to derive this accounting profit, certain expenses must have been removed and certain incomes must have been considered. By the time you prepare your account and you file for tax returns, the tax authority will scrutinize your returns to see the expenses you have deducted and the incomes you have considered to derive your accounting profit. So accounting profit, okay, is that profit that is calculated, okay, determined in line with the accounting standard regulations and all that. And it is based on this accounting profit that a company would have calculated its income tax provision, what they're supposed to pay, okay, which might not be true, because by the time the tax authority adjusts the account, the tax man is going to come about another tax that they are supposed to pay. Is that clear? So now, is the taxable profit. Now, I will call this, okay, adjusted accounting profit. Yes, Now, taxable profit. This is the profit, okay, that is calculated by the tax authority in line with the tax provisions. Remember that some item of expenses that the company has deducted as expense might not be allowed by the tax, right? While some incomes too that you have considered as company might not be what allowed by the tax. So the taxable profit is the profit that is calculated in line with the provisions of the tax law, or you may call it an adjusted accounting profit. Why? The tax authority is going to do some adjustment to the accounting profit that you have presented. Is that clear? And it is based on this taxable profit that the tax authority would determine your actual current tax to pay. Is that clear? Next now. Current tax. Class, current tax. This is the amount of income tax payable or recoverable in respect of taxable profit or loss for the period. Okay, the current tax is actually the amount of tax to be paid by an entity, and it is calculated based on the taxable profit. The last now, you should know here, the tax expense. Or the income tax expense. Okay. You know, class, earlier, I said that income tax, okay, expense is that figure you always have in your financial statement. When you say profit before tax, Abi, you will say less income tax. So this is the income tax, okay, we are talking about. Now, the tax expense or the income tax expense, this is the aggregate. The aggregate, the total, okay, in respect of the current tax and deferred tax. Hear me? That is why the stakeholders are more concerned about regulation of the income tax, because the income tax expense figure you always have in the account, okay, consists of 3 items. Yes, 3 items. Exactly. So we are coming there later, okay? So now that is that. Yes, the first thing we need to know now is the computation of the current tax and taxable profit. Let's see. For us to determine our current tax, okay, we need to ask, what is our taxable profit? Because that taxable profit is the adjusted accounting profit on which the tax authority will compute your tax liability. Okay. Now, computation of taxable profit. Okay, the computation, remember, it is the adjusted accounting profit. So you look at the question, what do I have there as my accounting, okay, profit? The accounting profit or loss, it is profit here, it is loss in jacket. Remember, before the taxpayer determines this profit, certain item of expenses must have been deducted, and these expenses might not be allowed, okay, for tax computation. They are called disallowed or not allowable expenses. You are going to add them back, okay, based on the question. Add. Not allowable expenses, e.g., depreciation, impairment, and what? Amortization. You are adding them back. Okay? These are non-cash expenses. 2, fines, penalties, okay, and entertainment expenses. You also add back. Next, there you have general provisions. For that food debts, okay? You also add back. Next, you have general donation. Okay, if the donation is made to non-approved body, general donations, you also add back. Next, loss on disposal. Okay. Anyways, see, private expense or domestic expenses. You add back, okay? So you have here next now. Are there any other income that are taxable but were mistakenly omitted by the taxpayer? Add. If you have taxable income, okay, previously omitted, you also add, okay? Now, are there non-taxable income that has been added by the company to get this profit? You less now, less non-taxable income, okay? E.g., you have your dividend to profit on disposal of asset or fixed asset. You also agree? Less. Over there. You have this now. And you have the adjusted profit. Now, less now, capital allowance. To have the taxable profit. In a class. Now you know that the current tax, okay, is calculated based on the what, on the taxable pro, okay. So class, we can now find out the current tax, Abi, the current tax. So computation of the current tax your current tax equals to the taxable profit times what? The tax rate. Okay, the tax rate. So, what is the accounting entry? Accounting entries. You debit. You know, tax is an okay, first. The P of L and what? The current tax payable as what? As your liability, as your current liability, it will appear, okay? Liability in the statement of financial position. You debit this, you credit this. Class, please, are we all there? Hello?
Well, sir.
Yes, sir.
Thank you. Now, okay. She goes, go on now. Why we look at the first question? She goes, please go on. The question.
Okay, sir. Is there any reason why we didn't add back loss on the
Honestly, I can't hear you. Maybe you are having a bad network, right? Class,
Back
look
loss.
at question number. Yes?
Is there any reason why we didn't add back loss on disposal of non-current assets?
Thank you. Yeah, thank you. Please mute your mic now. Now, according to the current tax law, okay, it is also treated as part of the business loss, okay? Out there. Aha. So, but in the old provisions, so we need to add it back out there. But based on the new tax law, loss on disposal is treated, okay, as part of the loss of the business. Exactly. So it means it is now allowed. Exactly. So question 12, class, please. 12. Are we all there? No, not 12. Sorry. I'm coming. It should be question 17. Okay, question 17. Please, are we all there? Everybody, you need to understand these two places. How to compute the taxable profit and the current tax. Because by next week, we are coming to differ tax. And I'll be taking questions that will cover all. So please, pay attention now. Okay. So let's go through it now. That question right away. Okay, go on.
Sorry, sir. Are we on tax now?
Yes. Go on, sir. Yeah.
I say, are we on taxation?
What?
No, it's FR.
This is IFRS.
Okay,
This is
sir.
income tax, okay, that affect business.
I thought I'm mixing it up.
This is IFRS class, not class.
What?
Question,
What,
sir.
sir?
17.
17. I can't see the question.
Can't you move now? You are disturbing us.
It's there. ABC Trader.
Hello, can anybody hear me? What happened?
I think
Everywhere
it's
is
up.
quiet.
Can't hear him again.
I guess it's network from his own side.
Your class, I think he dropped in.
He said till next week. Network logged him out. He said till next week.
That man need to rest. Need to rest.
Too
He's
bad.
trying.
He's
One
overstressing his brain.
man like that.
Yes, he's trying now, and has been consistent. He has been consistent. He doesn't miss the
It's
class.
not good. We can't afford to lose him.
Unlike some other lecturers, they'll just
Let
give
him
excuse.
rest.
He has been consistent.
I've never seen a man like that though. The man is not
Exactly.
the one that will not lose him.
Before the time, he's already on the call. Before the time.
Yes.
Some of those tutors, they will join you. They will even come late. They will give excuse after 1 hour. 30 minutes here, they are not done anything.
Then we need to also speak with him and counsel him. You know, there are many things for him ahead to do, so he has to program himself.
He's really trying.
The
Most
job.
of the lecturers he's bringing, they are not
He's a man
capable.
of words.
Yes.
So
They,
he doesn't
Very consistent.
And for him,
very
him using the chalkboard, using the board, most of them they use laptop. Just show you Excel
yes,
on this thing. But him, the
and
marker, the
and
writing, the standing alone. Most of those people that teaches, they are sitting down, no, they just
yes,
be using Excel. They are
He's
not
a
seeing
teacher
them.
now. He's not a lecturer. He's a teacher.
But him, he will even stand till the end of the lecture. He will stand.
no, he's trying.
This
We
is
need
what
to
we call
counsel
this is what
him.
we call born to teach. Is a born to teach.
Yes,
Yes,
Born to
yes.
teach.
yeah. Most times, most of our students, we even sleep off during the evening class. Sometimes, like we even sleep off. Honestly, sometimes like they are just like
I'm
ready
telling
to.
you, sir. So we
But
need to counsel him so that
it's not easy.
It's not easy. He's human being. He needs rest.
Question 17. Can we solve it?
Let us try and just read it now and just. So the account people with
Based on what he
800,000 naira.
Yes, 800.
Yeah.
You now add non-allowable expenses.
Yeah, you add it back. Your depreciation, amortization.
I'm fine.
Yes. I'm not sure if the interest on loan is it allowable? Interest on loan. If it's for the business, so if you collect the loan for the business,
It's allowable.
it's allowable, right? Okay.
Yes.
That is if it's for the business, the loan, if it's not for the MD that just need to go and flex you. That is the condition. If the loan is for the business.
That one is personal, so it's not allowable.
So, but if the loan is for the business, then I think it's allowable, like as I said.
Yeah.
So we also lessen capital allowance, 10% on building.
That's when you
50%.
10% building, 15% machinery. So you do 10% of 600,000. Then machinery,
Yes.
15% of 120.
So the tax rate is 30%.
Yes. You have to 30% of your total taxable
Yes.
profit.
And most of those things, if you usually check the audited account, it's always there. You know, sometimes some people don't understand when the auditors compute this thing for the company, it's always there on in the audited account. How they compute the income tax, the computation of accessible profit for the tax. So it's even good that if everybody learns it. So even when auditors prepare something nonsense, you can actually query them.
Yes, you can stand on your feet and say, no, this is not what it's supposed to be. That question, please, I want to, that cost of 70,000, is it meant, how are we going to treat it? Say the company has incurred borrowed cost of 70,000 in the year, of which 10,000 has been capitalized according to IAS 23. So we'll not touch it.
So I think for the company had incurred borrowing cost of 7,000 in the year, of which 10,000 had been capitalized. So they have been capitalized on the
10,000
in the books.
We deduct the 10,000. That's the borrowed cost.
Yes. And they pay fines of 125,000 naira.
That one you add back.
So we have to look at what IAS 23 is saying. According to IAS 23.
It's not done IAS 23. What is it all about? Okay, IAS 23 is borrowed cost.
Borrowed cost, I don't know if you are adding it back. You capitalize 10,000 naira.
You left it. We will left the
10,000 10,000 is what that's going to appear for the year. It's only 10,000.
Okay.
It's being capitalized 10,000 per year. And that current year, that's what they are paying.
Okay.
The fine is the fine is allowable expense. The fine is allowable.
Fine. Is disallowable expense. You add it back to the profit.
Yes. Then the tax written down value of machinery was 120,000.
Acceptable is the profit on disposal. 10,000, 100,000. Okay.
So we are going to calculate 10% capital allowance on the machine and the building, which is 10% annually.
That's 60,000.
Yes.
As the annual allowance, right? Annual allowance.
No, there's a capital allowance is claimable, which is 10% annual on building and 15% on machinery, applied to tax written down value, which is at the value of 600,000 and 120,000 naira at the start of the year. Okay. Tax is paid at 30% on after adjustable profit.
Okay. Thank you.
Do you guys know that most of the study center in Port Harcourt here, what most of those teachers does is they study what this man is teaching. Like now, what this man is teaching today, that's what they're going to teach next week. That's what they do in Port Harcourt here. That was why I have to disengage myself. See, let me come to online, since this is what they are when they come to learn, to start teaching us nonsense.
During the tax class, I saw my former lecturer there.
Oh my goodness.
I saw him, I saw his name. And when I asked, I said, what is this man doing here? So
what is he doing?
You will not come to teachers.
I said, if you look at I say there was a particular topic in my teaching us in the class in Port Harcourt. I have to call my colleague in the office. I come and look this thing. Look at my notes. The notes I copy in the class. Then look at this video that I saw on the net. We started looking at this is where this man came to upload this, started teaching us. In fact, he didn't even teach like what this man was teaching, what this person is teaching us. He didn't even teach like that. This man is a teacher, not a lecturer. He's a complete teacher.
Yes, sir. Compared to other people outside there, in fact, they will not even, some of them, they will use 10 minutes. They will say network.
The truth is that
We'll come back.
The truth is that
They say till next,
the truth is that
next week they will send.
I have not been following this at all because of the lecturer. The man taking us on PSAP. To me, it's not a good teacher. I'm not following that class at all. You know, I have told this man before. I've told him that I'm not following his class at all.
I don't know whether that was civil. This one that I think we're supposed to have tax in between FR and ISAC.
Class is by 3:30. I think the class need to end by 3 o'clock. This class has ended.
Okay.
This class has ended.